Hello everyone, welcome to our YouTube channel Sabka Banker. Through this channel we will explain important banking and finance related concepts. So in this video I'll be explaining you a very important concept and which is also in news these days, that is the bank recapitalization. Friends, as you all must be knowing that on 24th October, Finance Minister along with all his secretaries, they did a press conference whereby they have announced a 2,11,000 crore plan for bank recapitalization. So in this video, friends, I'll be giving you a broad overview of why bank needs capital. That is the very basic concept. Key, like we all are we all are reading in newspaper these days that banks need capital. So but why these banks need capital? Like they already have a lot of deposits with them, they can, why they cannot lend, and all those things we'll be discussing. Then we'll be looking at the proposed bank recapitalization plan, yes, the plan which was announced by government, and then what effect would this bank recapitalization will have on economy, how it will stimulate the economy. So let's move forward. So friends, as you all must be knowing that banks are an institution which accept deposit, yes, and to give loan. So what is the basic business of banking is to take deposits. Like हम लोग आप सबको पता होगा, हम लोग जाते हैं और वहाँ पे पैसा जमा करते हैं, and thereafter we take loan from the bank. But can banks give unlimited amount of loan or no? That is the question we have to understand. In fact, what happens is that banks' ability to give loan is limited by its capital. Banks cannot give innumerous amount of loans. So it is, suppose if I am a banker, I cannot accept 1,000 crore rupees deposits. I cannot give 1,000 crore rupees of loan. There has to be some limit on it, and this limit is imposed by something which is called as CRAR, that is capital to risk weighted assets ratio. I'll be explaining this concept of CRAR and how all these things are work, how all these things will work. But just for the information purpose, what I would like to tell you is that banks have to maintain 10.25% of CRAR as on 31st March, which will increase to 11.50% by 31st March 2019. So here is an example whereby I'll be explaining why banks need capital and how their lending power is restricted by this capital, for the want of capital. So suppose there is a bank called Bank A, which on 30th September 2017 has a capital of say 105 rupees, and then it has a risk weighted asset of some 1,000 rupees. What this risk weighted asset is, how this calculation takes place, we won't get into detail of this. So what is the CRAR percent is that capital divided by risk weighted asset into 100, that is 10.5%. It works out to be 10.5%. So on 1st October, suppose bank has to give a new loan of 200 rupees to a corporate. Suppose there is a businessman who gets into the branch of a bank and asks for a new 200 rupees loan. So if bank has the same capital and then giving a loan of 200 rupees to a corporate would mean, just for the sake of simplicity, we'll add 200 rupees in the risk weighted assets. So the risk weighted assets would become from 1,000 rupees to 1,200 rupees. So CRAR in that case would be 105 divided by 1,200 into 100 to convert it into a percentage, which will be 8.75%, which, friends, as you must have seen, that it has to be minimum of 10.25%. So bank will not be able to meet this CRAR requirement. So what you have seen is that despite bank having funds, it's not that banks do not have money with them. Banks have money. They may be having a lot of money with them after demonetization. But the thing is, banks can give loan only up to a certain level, which will be determined by their CRAR percentage. So banks need more capital. If you increase the capital, then this numerator will go up, and as a result, finally this will become 10.5% or any other ratio which is more than the minimum of this 10.25%. So coming to the next part, then the public sector banks, they are again facing a big problem. What has happened with them that due to very high NPAs, they have done kind of what we call as provisioning. Provisioning, let me explain you provisioning in bit detail. Suppose you have given a loan of 100 rupees to a corporate, and if it has turned into NPA, so there are certain norms prescribed by Reserve Bank of India by which a certain percentage you have to do a provisioning. That is, you have to deduct your profits or your income or by that value. So because of that provisioning, banks face loss, and when they face loss, this loss is finally results into reduction of capital. So what has happened in case of public sector banks, as you all must be knowing, that over a period of time, public sector banks have posted so much of loss that their capital in fact has reduced. It has not only been stagnated like we have seen in the previous example, actually it has gone down. So what is the problem with public sector bank? Then again, if you look at the gross NPA, they were 5.43% in March 15, which was around 2.78 lakh crore. And now in June 17, the same ratio was 13.69%, which is 7.33 lakh crore. So there is a huge jump. There is an addition of around 4.5 lakh crore. 4.5 lakh crore of gross NPAs have been added. How these have been added, the asset quality review of RBI, what all reasons are for NPA, that we will be discussing in some another video. But what has happened again, if you look at the previous slide, the same thing works out over here. High NPAs, which has resulted into provisioning, losses, then again erosion of capital, and again the capital has been reduced. So now the government has come up with this recapitalization plan of public sector banks, where they have said कि over a period of 2 years, some 2.11 lakh crore, really this is a very big amount, which will be injected into the banking sector. By meaning injected into the banking sector in form of capital. The most important thing is that it will be given as capital. So out of this 2.11 lakh crore, around 18,000 crore will come from budgetary allocation. What is this budgetary allocation? Means government in its budget will announce that it will give 18,000 crore. Then 58,000 crore will be achieved by selling government stake in the market. So PSBs will sell government stake in the market. Suppose the shares will be sold in the market, and government will get 58,000 and PSBs will get 58,000 crore. Then the third and the most important thing, which has got a lot of about which we'll be talking in this video, is that recapitalization bonds. Yes, some 1,35,000 crore would be through recapitalization bonds. Friends, in the press conference, finance minister has not told, or the government of India has not told what would be the exact mechanism for this recapitalization, how this recapitalization bonds would work. But we would be just trying the way it was done in 1990s. There are different ways by which it can work, these recapitalization bond. But in this video, we'll be explaining you one of those way, which was used way back in 1990. So before recapitalization bond, I'll tell you what bonds are. Bonds are, very simply put, they are instruments by which we can borrow money. So suppose there is an entity which sells a bond, which is again a piece of paper which promises that I will pay you back some interest and principal. So people purchase those bonds, and then I can, or the entity can, get money. Government bond allow government to borrow from public and banks, or maybe financial institutions, or maybe anywhere from overseas, or there may be so many different ways. So government will sell it bonds. It will give a piece of paper to individuals saying that you give me certain money, I'll pay you certain rate of interest along with the principal. Then again, this recapitalization bond, this will also be issued by government, or maybe a special purpose vehicle. We won't get into much details of it or complexity user, but it will be a bit different from government bonds. How this mechanism would work, this we will see in this slide. In fact, this is the way it has worked way back in 1990s. In 1990 it has worked this way. So we will just try to figure out, we'll just try to explain, I'll just try to explain in this key what recapitalization bonds are and how this entire mechanism would work. So what will happen, the government will sell some recapitalization bond, and the purchaser would be public sector bank. So public sector banks, they have enough funds with them, they have got, they do not have capital with them, but they have money with them. It's not that they are totally deprived of money. They have money, they have a lot of deposits of individuals. So public sector bank would purchase them using their funds. What will happen again is that once this bonds would be sold, so government will get some money, of course. Suppose what would happen, ki government will say ki, okay, buy this bonds. Once the bonds will be purchased by banks, then the government will get some money, because it is again a kind of instrument by which one can raise money. So after government will get money from sale of this recap bond, they will use again this money, the same money which they have got, to again purchase share of public sector banks. So consequently, suppose if shares are purchased, if more capital is put in, so bank's capital would naturally increase. Now the another very important concept which I'll be telling you, that this entire process would be cash neutral for government. Means first, government has got money from the bank itself, which in turn would be put into bank as capital. So government only has to pay interest, and in fact RBI has praised this entire mechanism, whereby it has told that this will be cash neutral or liquid or total government will only have to pay the interest, and it isn't that government has to put in some extra money or something like that. So the other thing is that the most important thing, the benefit of recapitalization bond would be that recapitalization bonds, they do not add to the fiscal deficit. Here friends, I will be talking about why government cannot directly put in money, because all of you must be knowing that government has got a fiscal deficit target of 3.2% of GDP. So if government spends more or maybe borrows more, then what will happen is that its deficit would increase. The gap between income and expenditure would increase. To put very simply, this is very simplistic thing which I am telling you in a very simplistic fashion. What has happened in this case, this again would be government taking money from the public sector bank, but under IMF convention, whereby how to calculate fiscal deficit, this recap bonds, they are not added to the fiscal deficit calculation. So this fiscal deficit will not increase by if government injects money by way of this recapitalization bond. Then the second advantage would be कि banks, they have excess funds after demonetization. As I have told you, these funds will be used to purchase this bond. So this will be they will have an avenue to invest these funds. Then once this entire process is stabilized, or these recapitalization bonds can be again sold by banks in the secondary markets, and they can generate even more funds. So you can well imagine the benefits of this thing, and this how much funds can be generated. It won't add to the fiscal deficit, and banks can use excess funds which they have got after demonetization. The other important thing is that this entire process is cash neutral for the government. Only government has to pay interest, and it won't result into any cash or any extra any extra spending from government. So now let us come to the last and the most important thing, that how this bank recapitalization will help economy. Friends, all of you must be knowing that for growth we require investment. So this investment, when we say investment, we means investment into factories, highways, roads, new buildings, bridges. So who does investment? Investment can be done by either government or corporate or private individuals. So government, suppose example, they start a factory, like they started Bhilai steel plant. So that was a kind of investment. Likewise, corporate also can start a factory, for example, factory set up by Tata. So what has happened, that for setting up this factory, especially by corporates, they require some fund, so they have their own fund which is called equity, but at the same time majority of it comes in form of debt which they get from banks, which is also called loan. So they will get loan from banks. So what has happened before recapitalization, what is the scenario right now, is that banks, they do not, I have told you that banks, they cannot give lend without any restriction. They have some restriction, they have to follow the CRAR. After then, which has resulted into less loan. If there is less loan, people, there will be less investment, less factory, less highways, and all this less will be built. So which will result into less growth, less jobs, then less income. So if people have less job, but obvious less income, and then it will result into less prosperity. So what will happen after recapitalization? Banks will be able to lend more, which will result into more investment. Once investment is more, but obvious growth would be more because new things would be produced. Once growth, this is again a very good cycle. Anything like growth can come after jobs, jobs can come after before growth. So a virtuous cycle would get into. So there will be more jobs, more income, and then again more prosperity. Thank you friends for watching this video. This was our first video, so there must be some things we'll try to improve upon it. Thank you, and subscribe to our channel. Thank you.